What is risk to reward ratio? We are learning about the fundamentals of Forex trading, currency exchange. So, if you already a trader, this is a review for you. But if you know to trading, I'm sharing with you so you learn some of the fundamentals. If you're already trading and you don't know those fundamentals, you have a recipe for disaster in your hands. But if you learn these basics like a foundation, a house sitting on a foundation, you need to have a good foundation to understand what the market is all about to help you become a better and a consistent trader. So let's look at what is risk to reward ratio. Risk to reward ratio is very simple. Okay. So the it is how much you risk compared to how much you can gain. Okay, it's a simple concept. Okay, so if you risk $100 to gain $300, your reward to risk ratio is 3 to 1. That's great. That's a very good risk to reward, 3 to 1. If the market goes against your position, now you're losing $100. But if it goes to your position, hit your profit, you'll make 300. So let's say for the day you did 5 trade, you lose 2. Let's say you lose 3 and you win 2. That's mean you lose $300, but if you win 2 of them, you make $600. Even though you lose 3 trade, this is why risk management is important. Reward to risk ratio is important. If you lose 3 trade and you lose $300 and you win 2 trade, you make $600. You see, you still profitable. Cool? That's important to understand as a trader. If you're risking $100 and you have a fixed $100 reward, you need to be right 50% of the time to be profitable. That's mean if let's go let's go to the market and take a look. So right now I have a position open. Okay, I open the position just to illustrate that point. Okay, so here is my position right now. I open it right before I start this risk to reward ratio. You can see I open it here and the market goes against me. You see if I lost that trade, I'm risking $1,650. What if I win that trade? If I win it, I will make $1,591. That means my risk is bigger than my reward. That means I have a 1.2 to 1 reward. 1.2 risk to 1 reward. That's not good. Your risk management should be better than this. So if I was in that trade, a better risk to reward ratio would be if it's here, if I put it under the EMA, it might go lower just in case. And then I have a reward ratio of, let's say, 1,500, 1,600. Now I have a 1.4 to 1. I have a 1 to 1.4. 1 risk to 1.4 reward. So if I lost that trade, I would lose $1,300. What if I win? I win $1,600. At least it's not a 1-in-1. It's not 50-50. It's more like 45-55. 45 risk, 55 reward. So that would be a better risk to ratio. But this is a bad trade anyway. So I'm just telling you. So this is a resistance right here. I should have waited until it get here if I would take a trade. to take the trade right here. If I take the trade here at this support level right here, you see where it was, it break it, it goes, it tested again, it tested again. You can see it's been testing. If I take it here, so my stop loss would be right down here under that that um, that candlestick right here. So I would risk 20, let's say about 20 pip. I would risk 20 pip, but let's look at the reward. If it goes in my thing up to, this is where it came from. I have a possibility for a 50 reward. I'm risking 20 to 50. That's 1 to 2.5 ratio. That's a better trade.